Welcome to ECNTRADE Daily Video. Before we begin, it should be noted that any advice is of a general nature only and that your personal circumstances have not been taken into consideration.
Hello everyone, my name is Rob Clayton and thank you for joining me. At present, the Australian dollar continues to waver above the key support level as it trades within a tight range of small gains and losses following a somewhat dovish RBA's final meeting minutes on Tuesday. In the minutes, the RBA December policy meeting showed its board considered pausing its hikes but decided the case for the quarter 25 base point to 3.1 was stronger, adding further interest rate increases in the new year if inflation continues to rise. The central bank chose to raise interest rates by another 25 base point this month, despite considering a 50 base point rise, bringing the overnight cash, that is, to, as I mentioned, to 3.1. Looking at the technicals, we can see that the key level of 66.60 was contested and posted an engulfing candle, but little to the fact that the market is still holding over that level, that is at 66.60. A break there would give confirmation to the downside and also to the engulfing candle and project a move to 65.35.45, which is seen where the 60-day moving average is. Keep an eye on these technicals. They are negative, so therefore could see further weakness, even though the US dollar did tumble overnight. The euro still holds above the key level, which is at 105.70. A break there would confirm this engulfing candle and give a projection down to 104.40. In light of the technicals, they are weak, even though the dollar did tumble overnight, as mentioned. And the fact is, as long as we maintain above 105.70, we should, at this point, not discard a challenge towards that top side. So we are in a mixed pattern here, but nevertheless, what's overpowering the call to the bearish case is the engulfing candle and also weak technicals. Dollar yen, well, the market was caught by surprise after the Bank of Japan changed its policy seating due to its surprise tweak to its bond yield control program. The market fell pretty much over 4% after the Bank of Japan said it would allow the benchmark 10-year government bond to yield as much as 0.5%, up from its prior cap of 0.25. The Bank of Japan since 2016 has maintained a cap of its 10-year bond yield to fight deflation. The tumble to the US dollar now holds around 103.50, which is a 6-month low. Keep an eye on that level of around 103.30, as this would see further US weakness. But we are pretty much oversold. There's a bottom of the range. So therefore, with some divergence seen here, $2 yen may find the base of 130.5 as a support and then look back towards 133.20.30 as the next call. In light of that, a break of 130.5 would leave me neutral in the short term. The pound still holds above the key level, which is seen around 120.25 as we coast sideways, and there's still little indication in this case to support a bullish move, and therefore may see another challenge to the downside, although it has been maintaining in a tight range for 3 days. Keep an eye on that level of 120.25 as a break there would give further indication towards the region of around 117.5. Well, due to the dollar falling, gold ignited to the bullish case and now looks towards its last challenge of 1,826 to 30. Be on your guard, the technicals are somewhat weak in light of the pattern overnight and therefore could see this recent gains given back and look back towards 1,798 to 1,780 and reassess from there. Finishing up with oil, as we can see, the market is holding just above that support level around 75.60 in light of firmer technicals and increasing momentum. Could now see a move up towards 77.35.55 and reassess from there, as a break there will give us a target of 79 to 81. In light of that move from that base of 71, it still holds. Well, that wraps it for today. Thank you very much for joining me, and as always, look out for the intraday report, and I hope you enjoy the rest of the day.